All right, so in today's class, we're going to go over the taxation of equity options. And as you're going to see, the taxation of equity options is pretty straightforward. It's that the uses of equity options, the uses of puts and calls, in conjunction with other activities and other actions that the taxpayer is taking, create very complicated tax situations, and other code sections are then enacted to deal with those other implications of using equity options. But the taxation of equity options themselves is pretty straightforward. And we've already gone through an example of how we can use equity options in order to thwart the wash sale rules, to get around the wash sale rules, right? We saw that we could double up a position by buying additional stock, and then through the use of equity options can create what would otherwise be a synthetic short position. And that's what creates the tax issues. It's the use of the equity options, not necessarily their taxation. Now, at the end of today's class, I'll show you where an investor or a taxpayer uses equity options, and then based on certain things happening, can use the different tax rules to create a tax advantage for themselves. But that's just a result of how the rules work. That's not something that is an abusive situation, or that you look for to, that we're creating something that Congress doesn't like. And the other code sections that we'll be discussing later, those are going to be code sections that are enacted because Congress doesn't like what you're doing with the equity options. In the reading material was a revenue ruling 78-184. That revenue ruling is, in my opinion, one of the best revenue rulings that the IRS has ever published. And the reason I say that is it actually explains the taxation of equity options. And there are things in that ruling that are no longer good law. And when you look at the ruling that's included in the classes, I've pulled those sections out, and I've put in the Word document that lets you see the revisions that I made. So it lets you see what I pulled out. And I had to pull out those sections because of changes in the law subsequent to 1978. If you pull up the 78 ruling on your own and you Google it, or you do whatever search you use to get that revenue ruling, your revenue ruling is going to still include all of that material that's no longer good law. So just be careful. But otherwise, with respect to the general taxation of equity options, that ruling is great. And you should keep a copy of it nearby, because if you're doing tax returns or doing tax planning for someone who's using equity options, it's a good little tool to use. It summarizes all the tax rules very well. All right, so let's start the class on equity options. I'm going to start by going to the PowerPoint. And then as we go along, as usual, I will add in the whiteboard. Now, for some reason, when I shared my screen, it didn't share the PowerPoint. So let me do it this way. And there you go. There's the PowerPoint. So it's equity options. So we're only dealing with equity options today. Equity options are governed by Section 1234. An equity option is a call option or a put option on a single stock. So an option on IBM or an option on Apple is covered by Section 1234. That's an option on a single stock. If we do calls and puts on stock indices, I want to buy a call on the S&P 500. That's not a single stock. That's an index of stocks. So yes, it's made up of stocks, but for tax purposes, that's not an equity option. That's going to be covered under a different code section. It's going to be code section 1256. And we'll talk about 1256 options at a later time. So what are the rules with respect to equity options? What are the rules with respect to a call on Apple? So under Code Section 1234, they tell you that the regular holding period rules apply. The holding period begins on the day after you purchase the call. Your holding period ends on the day you sell the call. And your gain is either long-term or short-term capital gain or loss, depending on your holding period for the call. So again, now let's go to the whiteboard. Let's just do some simple examples. So we have an IBM '85 call with an expiration date of July 31st. So again, just a quick review. This call gives me the right, the owner of the call option has the right to buy 100 shares. Each option covers 100 shares. To buy 100 shares of IBM at $85 per share. Sorry about that. At $85 per share by July 31st. Once we get to August 1st, if I don't exercise my option, I decide I don't want to buy the shares of IBM, that's it, my option expires. So the option expires on July 31st. If it's an American style option, it may be exercised at any time prior, well, at any time up to July 31st. If it's a European style, it can only be exercised on July 31st. And later on, when we talk about other uses of options, we'll talk about when we would prefer using a European style option as opposed to an American style option. Okay. So I buy one option on IBM. And by the way, when they give you a price, they're going to tell you the price for the option, and they'll say it's trading at $4. But because it relates to 100 shares, the actual price will be $400. So you multiply the price by 100 to get the actual price of the option. It's $4 per share, and it covers 100 shares. Okay, so now I've bought the option. And I paid $4 for it. So my basis is $400. And let's assume that I bought it on February 1st. And it's going to expire on July 31st of 2022. The entire life of the option is 7 months. We got February, March, April, May, June, and July. So if the entire life of the option is 7 months, then by definition, all gain or loss will be short term. However, if the expiration was 7/31/2023, there's a possibility I will hold option for more than 1 year. In such case, the holding period will determine whether it is long-term or short-term. Okay, so we buy the option for $400. Move this to the side. We sell the option for $500. We have a gain of 100. And then depending on the holding period, the gain is either long-term or short-term. All right, it's that simple. If I buy the option, I buy for 400, sell for 300. I have a loss of 100. And loss is either short-term or long-term, depending on holding period. So again, let's assume that I bought this option, and under the terms of the option, the strike price is 85. So remember, this 85 call option means that I have the right, as the option holder, to buy 100 shares of IBM at $85 a share. Assume that IBM never reaches $85 a share between now and July 31st. Well, if IBM never reaches $85 a share, I'm not going to exercise the option. If IBM is trading for $80 in the marketplace, I'm not going to exercise the option so I can buy it for 85 when I can just go into the marketplace and buy the stock for $80 a share. So if IBM never reaches 85, or if I haven't exercised or I have never sold it, and IBM is less than $85 on July 31st, I'm not going to exercise the option, right? There's no obligation on me to exercise. It's my option, it's my choice. So I let the option lapse. If the option lapses it is treated as sold for zero on the expiration date. All right. I let it lapse, it expires. So for tax purposes, it's as though on July 31st, I sold it for zero. If I bought it for 400 and I sold it for zero, and I bought it 7 months ago, then that loss will be a short-term capital loss. If I bought it over a year ago, I'm going to have the same loss. That loss will be a long-term capital loss. And those are the rules that for buying an option, for buying a call option. It's treated the same as buying any other asset. You look at holding period to determine whether your gain or loss is long-term or short-term. And if it lapses, it's deemed as though you had sold it on its expiration date. And so you're going to end up with a loss, and it'll either be a short-term loss or a long-term loss, depending on your holding period. So let's quickly go back to the PowerPoint. Hopefully this time I'll do it right. Yes, I did it right. And so what other choice do you have? You buy a call, your choice is you can either sell it or you can let it lapse. You can let it just become worthless. But there's one other thing you can do. You can exercise your call option. If you exercise the call option, you're now buying 100 shares of IBM for $85 a share. When you exercise the call option, what's that? That is treated as a purchase of stock for tax purposes. Since it's a purchase of stock for tax purposes, it's a non-taxable event. Your holding period for the stock does not include the holding period for the call. When you exercise the call, it's as though you bought the stock that day and your holding period starts the day after. It's treated as any other purchase of stock. And what's your basis of the stock that you've acquired? It's equal to the strike price, the amount that you pay under the option, plus the premium that you paid to buy the option. So again, let's go back to the whiteboard and let's do an example. All right, so once again, let's buy one call IBM at 85, the strike price of 85 at $4 per option. So we're spending $400 on day one to buy the option. Now we're near the end of July. IBM's trading for, and IBM is trading for $86 a share. And the question is, what am I going to do? Am I going to exercise the option? Am I going to let it lapse? Even though I paid $4 for it and the option is only worth $1, I'm going to exercise the option. To let it lapse would be throwing away money. So we're going to exercise the option. And when I exercise the option, I'm going to buy 100 shares at $85 per share. And let's assume that I exercise on July 31st. Now, I've held that option since February 1st. I've held the option for 7 months. The holding period of the option is irrelevant. I am treated as purchasing the shares on the date the option was exercised. So if the option was exercised on July 31st, I'm treated as though I went into the market and bought the shares on July 31st. My holding period begins the next day. So your holding period begins on August 1st. And my basis in the shares equals strike price plus option premium. So in this case, and I don't have room at the bottom of that screen, unfortunately. So, but in this case, my basis is the strike price, because that's the amount that I'm actually paying when I exercise the option. Strike price is $85. And my original premium was $4. So my basis is $89 per share. We're dealing with 100 shares. So my basis equals $8,900. So that's what happens when you, for the buyer of the call option. Either they're selling the call option or they're exercising the call option. And those are the tax results. Now let's look at the seller of the call option, because the seller has slightly different rules. The seller of the call option, and in market parlance, what we call the seller of the option is someone who's writing the option. So if I tell you that someone writes a call option, it means they sold the call option. So in the prior example, when the person bought the call option for $4, someone had to have sold them that call option. And that person sold them the call option for $4, and that person took in $400. The taking in of that money is non-taxable. And it's non-taxable because when you sell a call option, you've placed an obligation on yourself. If the person who bought the call option exercises the call option, which they're not obligated to do, but once they exercise it, you are obligated to sell those 100 shares at the strike price. So since you've set up a liability equal to the same amount of the money you took in on day one, taking in the money is a non-taxable event. When you close your position, the way you close your position is you go in the marketplace and you buy back the same call option. You then compare your selling price with your purchase price, and the difference is either gain or loss. When you're the seller of the call option, we don't care how long the transaction was held open for. Any gain or loss on the closing of that transaction is short term. So let's go back to the whiteboard. We now have the seller of the option. Seller of option receives $400. That's non-taxable. And then in the future, they want to close the transaction. The way they close the transaction is they buy back a similar option. And like everything else, we're going to compare amount realized with basis. And the difference is gain or loss. But in this case, regardless of holding period, regardless of how long the option was outstanding, the gain or loss is always short term. All right, so I sell the option for 400, I buy it back for 300, I have a $100 gain. We don't care how long the transaction is held open. It could have been held open for a month, it could have been held open for a year and 2 months. It doesn't matter, that gain is short term. Likewise with a loss, I sold it for 400, I buy it back for 500. I have a $100 loss and the loss is short term. It doesn't matter how long it was held open for. Okay, so now we know that the option can either be bought back, where you buy back a similar option, and that would be a closing transaction. We measure gain or loss, or the option could have lapsed. The option holder never exercised it. You sold the IBM option, strike price of 85. IBM stays below 85. The option lapses. When the option lapses, you have a gain and it's short term. And your gain equals the amount of proceeds you receive. All right, so I think that's all fairly straightforward. So now the last thing that can happen to the person who writes the option is that the option gets exercised, right? The owner of the call says, hey, IBM's trading at $90 a share. I want to exercise my option. So when the buyer exercised their option, let's just review that quickly. They're buying the shares. Oh, I hit the wrong button, sorry. Having problems doing with what I want to do with the whiteboard. Give me one more shot. Okay. So again, the person who buys the option buyer, bought the call for strike price was 85, and they exercise it. Their basis is $8,900 in total. It's $89 per share, $8,900 in total. Now we go to the option seller, the option writer. They received $4 for the option, and in dollar terms, they received $400. The option buyer now exercises the option, they have to sell 100 shares at $85 per share. So the question is, what's their amount realized? So we know that they're receiving $8,500. What we add to that, so it's plus premium received. And the premium received was $4. So per share, amount realized is $89 a share. And the total amount realized is $8,900. That's the total. So we know what the amount realized is, but what's their basis? It's the cost of the shares being delivered. So many times when people write calls, they already own the shares, and their strategy is to write calls on the shares they own to try to increase their rate of return on the stock. They've received an additional $400, and they're hoping that the call is never exercised and they can keep the $400. So let's assume they're holding shares, and it was held for more than 1 year. And their purchase price was $60 per share. Right. So they're selling for $8,900. Basis was $6,000. Sorry, let me fix this. 8,900, basis was 6,000. They have a gain of $2,900. And we look at holding period of stock. This now becomes a sale of stock. It has nothing to do with options anymore. And the holding period of stock determines the nature of gain. So in this case, because the stock was held for more than 1 year, the $2,900 gain would be a long-term capital gain. It is no longer an option transaction. It becomes a stock transaction. And again, they're selling the stock. They're getting $85 for the stock. They add the premium. That's $4. That gives us a selling price of $89. And what you see is that we have symmetry between the buyer and the seller. The buyer's basis is $8,900. The sales, the amount realized for tax purposes by the seller is $8,900. So they're equal. All right, so those are the rules with respect to call options. Now what I want to do is cover put options. So again, let's go back to the whiteboard. And now we're dealing with put options. And again, let's assume we have the same characteristics. It's IBM, $85 strike price at $4. Now, what's different about a put option is it gives the owner has the right to sell IBM, not the right to purchase, the right to sell. So if IBM goes down and you just buy a put on IBM, you've made money. That's what you want. If IBM goes up, you're going to lose the $4, right? If IBM is trading at $90 when this put expires, it has no value. Why would you sell it and exercise the put and sell it for 85 when you go into the market and sell it for 90? So it's the exact opposite economically of a call option. But the tax rules for puts follow the rules for calls. So what do I mean by that? If you sell the put, you buy the put, now you sell the put. You do amount realized less basis. That gives you your gain or loss. And the holding period of the put. Determines character. Hold for less than 1 year, right? Less than 1 year. Short term. More than 1 year. Long term. And technically, if I hold it for exactly 1 year, it's also short term. Long term has to be more than 1 year. And then when we go to the seller of the put option, it's the same rules as for seller of call option. Compare amount realized with basis. That tells us if we have a gain or a loss. And then all gains and losses on closing the short position will be short term. Right, when you're selling the option, that's a short position. It's not short, and they really shouldn't use the word short. We're not borrowing anything. It's very different than a short sale of stock. It's just that's the nomenclature used in the trading industry. So when you're a seller of an option, you're short the option. But the point is, when you sell a put option and then you close the transaction by buying it back, if you have a gain or a loss, that gain or loss is short term regardless of holding period. It's the same rules as with respect to a call option. So now let's go to exercise. What happens when a put option is exercised? So now we're going to have and remember, who exercises the put option? The buyer of the put option. The buyer of the put option has the right. They can either exercise it, they don't have to exercise it, they can let it lapse. The writer of the put is obligated. If the buyer of the put exercises the option, the buyer of the put is going to sell the shares. The writer of the put must buy the shares. So now we have put option being exercised. So again, we have IBM $85 strike, and it was bought for $4 per option. And at expiration, IBM is below $85. Well, if IBM is below $85, the owner of the put's going to exercise the put, right? If IBM is trading at 80, they're not going to go into the market and sell their IBM stock for 80. They could just exercise the put and sell it for 85. So the exercise of the put is treated as a sale of the stock. So in this case, what's the amount realized? The amount realized equals the strike price, the amount that you're receiving, less the premium paid. Right, because you're receiving the 85 and it costs you $4 to get it. So in total amount realized in this case equals $8,100. And now we want to see if you have a gain or a loss. We compare that to your basis in stock delivered. Again, let's assume that you were holding on to 100 shares of IBM that you bought years ago, and your basis is $2,000. If your basis is $2,000, your amount realized is $8,100. You have a long-term capital gain of $6,100. All right. Again, the exercise of the option turns the option transaction into a stock transaction. You are now deemed to have sold your stock. How much did you sell it for? The strike price, 85, less the amount that you paid for the put option. So you're deemed to have sold it for $8,100. Your basis is whatever you paid for the IBM stock, $2,000. That's a $6,100 gain. And your holding period goes by the holding period of your stock. And if your holding period is more than 1 year, it's long-term gain. If it was less than 1 year, it's short-term gain. And so finally, we now have to look at the writer of the put. Well, when the put is exercised, the writer is buying shares. You're putting the shares to the writer. You're making them buy the shares at the strike price. Put is exercised, the writer must purchase shares. Well, if they're purchasing shares, it's a non-taxable event. They're buying shares. That's not taxable. So the next question is, what's their basis in the shares acquired? The basis in the shares acquired is the strike price, because that's what they have to pay. So the strike price is 85. However, the way they got into this position is they sold the put. They received the premium. So we subtract the premium that they received, less premium. And the premium was 4. So their basis is $81 per share. On total basis is $8,100. And once again, we have symmetry between the purchaser of the put and the seller of the put when there's exercise. Our basis of $8,100 as the purchaser equals the amount realized to the, as a purchaser of the stock, equals the amount realized on the sale of the stock to the put option owner that exercised their option. So these are the rules with respect to puts and calls. I don't think the tax rules with respect to how you measure gain or loss, whether it's long-term or short-term, what happens on exercise is that complex. So yes, you do have to learn the rules. They're not simple, but they're not that complex either. So I said I would show you a planning technique that you could use with respect to options and stock. So let's do that, and that'll be how we'll wrap up this class. So let's assume that I own, so investor owns 100 shares of IBM with a basis of 2,000, and it was acquired 3 years ago. IBM is now trading at $83 per share. And I write, sell one IBM 85 option that's going to expire on July 31st. And I receive $4 for it. And now we come to July 30th. And on July 30th, IBM is trading for $100. I have a choice. I could just wait till the next day. I know the option is going to be exercised. When an option is exercised and you're the writer, the person exercising is called exercising the option. The person who wrote the option is being told they're being assigned the option. So the option will be assigned. And I'm going to be obligated to deliver my stock. So if I deliver stock, what's my amount realized? My amount realized is the $85, the strike price of the option. So it's 85 plus, plus the $4 that I received when I wrote the option. So it equals $89 per share. So in dollar terms, my amount realized equals $8,900. My basis is $2,000. And my gain is $6,900. And it's all long-term. Now, what's interesting is I wrote the call option, and because when the call option was exercised, it all became a stock transaction. The proceeds that I received for writing the call option get thrown into the stock transaction, and I actually end up with additional long-term capital gain. So this is very nice. I've got a $6,900 long-term gain. But what can I do instead? What I could do instead is I could buy back the call option on July 31st. On July 30th, right? So on July 30th, the day before it expires, if IBM is selling at 100 and the strike price of the option is 85, I'm going to have to pay $15 to buy back the option, because it's worth $15. The owner of the option can sell the stock for 85. It's trading for 100. The difference is their profit. That's the value of the option. So I can buy back the option. If I buy back the option, what was my amount realized? My amount realized was the amount that I received when I sold the option. My amount realized was $400. What's my basis in the option? My basis is $1,500, and I end up with a loss. And the loss is $1,100. But for tax purposes, it's a short-term loss, right? Anytime that I sell an option and I close a transaction by buying back the option, your gain or loss is short-term. I end up with a short-term loss of $1,100. And now I'm left with the stock, and I don't want the stock anymore, so I sell the stock, right? Because if I was going to allow it to be exercised, I was going to sell the stock anyway. What's my amount realized? My amount realized now is $100 a share. So my amount realized is $10,000. My basis is still the same $2,000. So now I have a gain on the stock of $8,000. That gain is a long-term gain. When I net the two together economically, my profit is still $6,900. Nothing has changed economically. I made $6,900 by allowing the stock to be called away from me. I'm making $6,900 if I break out the transaction into two transactions. The difference is the way, for tax purposes, I now have a long-term gain of $8,000, and I have a short-term loss of $1,100. And when you look at this transaction by itself, it doesn't matter, because if I have long-term gains and short-term losses, when everything's all said and done, I net them. But if I have short-term gains from other transactions, so I'll do this over here, other transactions having nothing to do with this transaction, I've got $1,100 of short-term gains. If I let the call be exercised, I end up with $6,900 of long-term gain from the exercise, and I'm going to pay 20% tax on that. And that's going to equal $1,380 of tax. But I'm also going to have $1,100 of short-term gains. I'm going to pay 37% on my short-term gains. And I'm going to pay $430 in tax. So when I combine my total tax payments, I'm going to pay $1,810 in tax. And that's if I allow exercise. If I don't allow exercise, I buy back the call. So if I buy back call, I have an $1,100. If I run out of room, I'm going to have to go to the top left. So I apologize about that. I'm going to have an $1,100 short-term loss. And then when I sell stock, I have an $8,000 long-term gain. So yeah, I apologize. I'm going to have to finish the example in the upper left. So that's a problem with the whiteboard, but hopefully you'll be able, for when you're doing this on your paper and you're writing this down, you can just keep writing where you're writing. Let me just fix this. So we're buying back the call. We have an $1,100 short-term loss. We sell the stock. We have an $8,000 long-term gain. So now when I do my tax return, I go, okay, what's my short-term gain? I started with an $1,100 short-term gain. Now I have an $1,100 short-term loss. I have zero short-term gain or loss. And instead, I'm now left with $8,000 of long-term gain. I'm going to pay a 20% tax, and I'm going to pay $1,600 in tax. So by doing it as two separate transactions, I end up paying $1,600 in tax. If I let the call be exercised, I'm going to end up paying a total of $1,810 in tax. This saves me, I've just saved $210 in tax. All right, and the difference is because I've converted $1,100 of short-term gain effectively into $1,100 of long-term gain. And I'm doing some math wrong, which is embarrassing. So it's 1,380, 370. Yeah, this is the number that's wrong. 1,100 times 37% isn't 430. It's 403. So I apologize. But the amount of savings that I should save, and you're going to have to redo the numbers, so I apologize for that. That's the problem I have with doing these in my head. The tax should have been 403. I should have paid 1,783 in tax. Now I'm paying 1,600. I should have saved. What I should have saved is the difference in tax rates, 17% on $110. Because I've converted, I'm sorry, on $1,100. Because I've in effect converted $1,100 of short-term gain into long-term gain. 17% of $1,100 is $187. So when everything's all said and done, I should have saved $187 by doing transactions. So I apologize for doing the numbers wrong. Let's do them again and see if I can do them correctly this time. So I'm going to do it in the middle column. Let's get rid of this line. I know that by allowing the transactions to be kept apart, so I allow, I'm sorry, so by allowing exercise, at the end of the year, I'm going to have $1,100 at 37%. And I'm actually going to do the calculation. I don't want to mess it up again. Right, so this is like doing a class in person. Sometimes we make mistakes. Times 1,100. And that's going to be $407 in tax. And then I'm going to have 6,900 at 20%. And that's going to equal, let me do that and make sure I don't do that wrong. That's 0.2. So that one I got right is 1,380 in tax. And my total tax equals $1,787. If we break into two transactions, I showed you that all we end up with is $8,000 of long-term gain. And that's going to be at 20%. And so that's going to end up with a tax liability of $1,600. And we're going to save $187. So eventually I was able to do the numbers correctly. It gives you a chance now to do it more than once, I guess. But this is the logic. So because we know the tax rules and we say, gee, if I let this thing get exercised, it all becomes part of one transaction and I end up with just a long-term gain. If I break it up into two transactions, I can actually end up with a short-term capital loss and a long-term gain. And that gives us a better result only if we have other short-term gains from someplace else. If we don't have other short-term gains from someplace else, it doesn't matter, but it's something to keep in mind. So in any event, we've gone over all the rules with respect to the taxation of equity options. I've now given you some planning opportunity at the end. If you do have clients that have written call options against their stock and the stock has gone way up, this is a way for them to take advantage of that by not allowing the call to be exercised against them. Again, read that revenue ruling, and I would keep that revenue ruling handy. So in case you're doing you have a client that does transactions in stock options, you'll have the rules right there on your desk. All right, so so that's it for equity options, and that'll be so that's the end of this class. Thank you.